Monetary Policy Committee resolution. As I mentioned, we met these last 3 days, concluding today. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook, as I mentioned, we are forward-looking, the MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the Standing Deposit Facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. The MPC also decided unanimously, again, to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this, now I come to the assessment of growth and inflation. First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity, bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced.